I've known every Chad and Brad and Chet and Brett out there, and some of them, they're lovely, amazing guys. But sometimes they say dumb shit. I'm Amanda. Some of you may know me as the Dumpster Doggy, and I've been working in and around investment management for more than a decade. And frankly, we are currently living in a high time for some breathtakingly bad investing takes. So I am starting a mini YouTube series called Call Them on Their Bull, where I take down the internet's worst investing advice. Maybe you've heard of the divest movement. Well, this is the divest movement, where I teach you investing best practices, but without all the condescension of a Patagonia fleece vest. Today, we are going to be talking about making money fast. Here's a little riddle for you. If a finance bro makes money fast and doesn't tell the internet about it, did it even really happen? Say that you're saving up for a goal that's 1, 2, or 3 years from now, like maybe a wedding or a down payment. How can you invest that money? Is there a way to invest that money? The Brads of the internet say yes. Put it all in Bitcoin, GameStop, Tesla, or even in an index fund. We're gonna check in with Brad. Is Brad talking about how much he hates keeping money in a savings account or condoms? Yeah, it's a risk, but it just feels better. Live a little. Come on, babe, there's no fun in that. Brad is indeed referring to the use of a savings account. We say to ourselves, if Brad can turn $1,000 into $10,000, then surely I can too. Like, how can I, a person of superior intelligence, dip my chip in that hot queso dip? Like, I want part of that action. And to answer this question, I want us to start here. The definition of investing is taking a risk in order to try and make money. Risk means that you could lose money. Quickly, let's talk for just a moment about the difference between gambling and investing. Say that you're seeking out a high, for example, right? Like, there's a big difference between a workout high, like mustering up the bravery to try a new workout class, and say, taking a pill that you found on the bathroom floor of a concert venue, right? Like, this is controlled risk. This is unmitigated risk. Really, this is the difference of investing and gambling. Take a walk with me into a casino. Maybe it's Vegas, but knowing us, it's probably Reno. We head to the roulette table. You put $1,000 on black. We know that the odds are bad. We understand that we'll probably lose, but we're really doing this for a spiritual thrill, right? Something to make my cold, dead heart feel alive inside. Work. And you should think of short-term investing, specifically in the stock market, but also the crypto market, in the same way. And by the way, investing in an index fund that holds a bunch of stocks, that is an investment in the stock market. Investing in individual stocks, that's also an investment in the stock market. Because here's the thing, the stock market could be up 20% over the next year, or it could be down 20% over the next year. Seriously. Not only are both of these outcomes totally possible, but both outcomes would be normal. Like, I really mean that. They would be normal. I could just stop there and say, if you don't want to mess with this, just put your money in a savings account and call it a dang day. But this is a really good opportunity to discuss 3 really important investing concepts. Side note, if I had named this video 3 super important concepts of investing, would you have watched it? No, we had to make fun of Brad. Poor Brad. In investing, risk and reward are 2 sides of the same coin. You do not get to have one without the other. So if you want a chance to achieve, say, 20% or 30% returns over the next year, you have to take the risk that you could lose just that much, right? Like, if there was like some guaranteed way to make 30% returns over a year, we would all be doing it. I would not need to make this YouTube video right now. And in fact, we could all technically be infinitely wealthy with the use of leverage, but that's beside the point. And then I really wouldn't be here right now. So here's something that is really counterintuitive about investing in the stock market. Broad stock market investments, so for example, an investment in the US stock market using an index fund, it actually becomes less risky the longer you hold it. And so it is actually much, much riskier to use the stock market for an investment 2 or 3 years from now. And it's far less risky if we want to use it for our badass granny future retirements. Second, understand what causes price changes in the market, especially in the short term. In the short term, prices wriggle around, we call that volatility, because of the buying and selling of that investment. So if a bunch of people buy in, that increases demand, that pushes the price higher. If a bunch of people are like the Drake meme, and they bail out, they sell out, that drops the price lower. And so then the next question is, why do we buy and sell? And the answer is for lots and lots of different varied reasons. You might be selling for a different reason than I'm selling. Sometimes we make these moves as a collective in mass, and it makes total sense, right? Like an example of this would be a company reports a better than expected quarter, so a bunch of investors buy in, that pushes the stock price higher. Sometimes it makes no sense whatsoever. Maybe Elon Musk wipes from back to front instead of front to back. This upsets investors and the markets go haywire. Like, who could have predicted that? Like, sometimes you feel like you could anticipate what's going to happen in the markets. Other times it's a crapshoot. It's a total crapshoot. So therefore, on a day-to-day or even a month-to-month basis, markets are basically just drama. They're basically giant mood rings. And they do not always move on easily predictable fundamentals, right? Just to drill this point home, it's already really hard to pick companies which we think are going to be real winners, which are going to exceed expectations for profits in the next year. And even if you get it right, even if you pick the right ones, the stock price might not actually reflect what's going on, because there are actually millions of global factors that impact the reasons investors decide to buy or not buy into the stock market, right? Like, investors can decide to punish or reward companies for no apparent reason. Sounds like me and every boyfriend I've ever had. But what we see happen is that over the long term, the market shakes off most of this noise, most of this drama, and reflects company profitability. But again, you have to give it time. You have to give the stock market time to reflect that profitability. And also, side note, we invest in companies not because we think that they're going to grow 100% this year, right? Like, do we even want them to grow 100% this year? But maybe they will over the course of a couple of economic cycles. Third, let's get to know the market a little bit. Now, you might be thinking, wait a minute, lady, I thought that the stock market was up 10% per year. Well, yeah, historically it is, but that 10% number is absolutely an average. And that average includes the occasional bummer year. That's what we mean when we say that the market grows in cycles. Cycles are these somewhat unpredictable growth patterns, which frankly put freshman boys and cowlicks to shame. They are also why finance goobers like me encourage you to apply your money to the market for as long as you possibly can. Basically, what you're trying to do is go from applying your money to a growth trajectory that looks like this to one that looks like this. Here's a real world example. From the peak of the market to the trough during the crash in 2008, the US stock market was down 55%. So if you had invested $10,000 for, like, let's say your wedding, in an S&P 500 index fund in 2007, well, by March of 2009, that $10,000 is now worth $4,500. Sorry, Grandma, you can't come. We can't afford you. Maybe watch from the shed. Since then, the market has come up a lot, like more than 400% a lot. But the problem is we can't know when those big up times will come, just like we can't know when the big down times will come. Now, all of that said, you're not going to go to jail if you decide to invest some money for a short-term purpose. If you want to take that risk, if you're comfortable with it, then go for it. Just know that you are no longer on your own timeline. You are on the market's timeline now. It could work out great for you, but it could also not. What happens in the short term in the stock market or with crypto is ultimately a gamble.